and I am an economics teacher. Today I am going to discuss a very important topic of macroeconomics, that is aggregates related to national income. This topic is very important from examination point of view because it contains 10% weightage in board examinations. So let's start the topic. As this topic is centered around the national income, so first of all we will understand what is the national income. To understand the concept of national income, let us recall what we have studied in previous chapter. Basically, I want to discuss about the factors of production. Factors of production, imagine or suppose you are a producer and have to establish a firm of tea. You have to establish a firm that produces tea. So, to establish such firm, what you need? We require four factors. We require four factors to establish a firm like producing a tea, and that four factors are, first of all, we will require land over which we will establish this firm. Second factor of production, we will require capital, or you can say machines. We will also require laborers or employees to work in this firm, and the fourth factor which will manage all the functioning of this firm, that is the entrepreneur. And these factors of production will help us for in the production of tea. So these are the four important factors which we will require for the production of or the establishment of a firm which is going to produce tea. We have employed these four factors, but on the other hand, we will require to pay all these factors. We have used land, and for that we will pay it in the form of rent. So the income earned by the land, it is in the form of rent. The capital, the income earned by these capital is paid in the form of interest. Because we require heavy machines for our firm, so we are not able to purchase it on cash. So what we will do? We will purchase these machines in terms of loan, and to repay the loan we have to pay the interest. So the income received by these capital is paid in the form of interest. Next factor of production is employees. Whatever is paid to these employees in the form of income, that is considered as wages, or we also call it as compensation to employees. Next is the entrepreneur. The fourth factor of production is the entrepreneur. Whatever entrepreneur is paid, that is called profit. We named it as profit. So these factors are paid in the form of rent, interest, compensation of employees and profit. And the sum of these factor income is called as national income. The sum of these factor income of the residents of the country during an accounting year is called as national income. So we have reached to the definition of national income. And what is the definition of this national income? National income is defined as the sum total of factor incomes. These are the four important factors of production, and the income paid to these factors is the rent, interest, wages or compensation of employee and profit. So the sum of these factor incomes, the sum total of these factor income of the residents of employee during an accounting So now we have understood that what is national income. But the definition of national income has two important points. First one is these factor payments should be the resident of a country. Resident of country. Resident of country. Why we are emphasizing upon this resident of a country? Because the concept, we need to understand the concept of resident. Residents are those who are living in our country for one or more than 1 year period of time. Those people are called the resident of country, and their economic interest should also lie in that country. Those people will be considered as the resident of country. So we have understood who are the resident of country. To be a resident of a country, a person must satisfy the two conditions. First one is live for a period of 1 year or more, and second condition which should be satisfied, that their economic interest should lie for the same country. Then such persons are called the residents of country. The second important thing which has been emphasized in the definition of national income is that these are only the factor payments. Either we call it factor payments or we can name it as income also. So these payments or income should be of only two factors of production. Will be of only these factors of production. So whatever payment or income we are considering, that is for these factors of production. So this is the two important points which we are emphasizing over the definition of national income. So once again I would like to recall the definition of national income, that national income is the sum total of factor income of residents of our country during an accounting year. So we have now understood the concept of national income. I hope everyone is clear about what is the national income. As we have understood what is national income, now I will move forward and we will understand some concepts related to this national income. I have classified these concepts in three categories, or you can take three groups. In group 1, I have taken the concept related to domestic and national, and in second group I have put gross and net, and in the third I have taken the concept related to market price and factor cost. So let's start. Let's understand what are these concepts related to income. So domestic and national. When we understand the concept of national income in terms of or at domestic level, then it is called as domestic income. And when we understand or consider the concept of national income at national level, then we call it as national income. So what is the difference between this domestic and national? Let us understand or know what is the difference between domestic and national. For that, just take an example. I am going to take an example. Suppose domestic income. But the income earned by your brother, which is living in London, and he is sending some money, or he is financially helping to your family also, but the income which is sent by your brother to your family, we will not consider it in domestic income, because domestic income means the income earned by the factors within the territory of the country. It means the factors which are in the domestic territory of the country, only those factor incomes are considered under the concept of domestic income. So, because of that, we can't include the income earned by the brother which is living in London. But then what we will do of this income, where we will consider it? We will consider it when we will talk about the national income. So, when we understand the concept of national income, then we will include the income earned by this domestic country plus the income earned by the resident of India who is living abroad, and deduct the income earned by any foreigner living in our domestic country. So, what will be the national income? It will be the income earned by the residents of our country plus residents of our country who is living in foreign minus income earned by the foreigners living in India. So that will constitute the national income. So basically the difference between this domestic income and national income is only of the net factor income earned from abroad. That is NFIA, that is the net factor income from abroad. When we consider the domestic income, we will exclude this net factor income from abroad. But when we talk about the national income, we include this net factor income from abroad. So this is the basic difference between the domestic income and national income. After this, we will come to the concept of gross and net. Now coming to the concept of gross and net. The difference between the gross and net is of only the depreciation. Depreciation, or we can also call it or name it as consumption of fixed capital. Whenever we use heavy machines or we add the net indirect taxes that I have written by NIT. It means net indirect taxes. So when we consider about the market price, it means we are going to include net indirect taxes. And when we consider or take the factor cost, it means we have to deduct the net indirect taxes. And how we calculate this net indirect taxes? The formula for net indirect taxes is indirect taxes minus subsidy. Because why we deduct these subsidies? Because these subsidies are given by government to facilitate the production process. So we deduct these subsidies, and these subsidies reduces the prices of goods, or you can say it reduces the cost of production. And whereas these indirect taxes, it raises the price of the good. So when we calculate the net indirect taxes, we deduct subsidies from indirect taxes and we get net indirect taxes, which we add or include while calculating the market price and deduct while calculating the factor cost. So this was the basic difference between these concepts related to domestic, national, gross and net, and market price and factor cost. Now we will come to the aggregates related to these 6 concepts. Now coming to the various aggregates related to these concepts, we will first of all discuss the GDP. Suppose we have to calculate the GDP, that is gross domestic product, or you can say GDI, gross domestic income. Basically in this concept we take gross domestic product equal to gross domestic income, because finally these factor payments are considered as income. So they are the concept of product and income is similar for these aggregates. So when we are talking about GDP and we have to calculate it from the net domestic product, then from gross national product, we have to calculate GDP from GNP. Then what we will do? I have told the basic difference between this is of net factor income from abroad. So that is NFIA. So when we will calculate the domestic, then we deduct or exclude this NFIA, that is net factor income from abroad. And when we have to calculate GNP, that is gross national product, then we have to add this NFIA on GDP. So in this way we convert GDP to GNP to GDP, and from GNP to GDP, and from GDP to GNP. In this way we convert these both aggregates into one another. Now coming to the gross and net. Suppose you are given the gross domestic product and we have to calculate net domestic product. GDP is given and we have to calculate net domestic product. So to calculate net, we have to exclude depreciation. It means we are going to subtract the amount of depreciation from gross domestic product. But when we are given taxes. And in this way, we are converting GDP at FC from GDP at FC to GDP at MP and from GDP at market price to GDP at factor cost. So, these are the concepts with the help of which we can convert the following aggregates into one another. Now we have understand how we will convert these aggregates into one another. But before that, let us understand these terms in a little bit definition form. So, how you are going to define that what is GDP? Actually, it is the monetary value of all final goods and services produced within the territory of a country during an accounting period. So, it is because it is talking about the domestic, it is a domestic concept of income. That's why we are focusing that it should be produced. It will include those goods and services which are produced within the boundary of a country, and that's why it excludes NFIA, that is net factor income from abroad. On the other hand, GNP, it is the gross national product, which means monetary value of all final goods and services including net factor income from abroad. So it is not bounded by the domestic territory, it also includes the income earned from abroad. And this NFIA is calculated by including the income earned from abroad and deducting the income which is going out of this domestic country. So through that we can calculate NFIA. Now coming to the net domestic product. This net domestic product, as we are considering here the concept of net, this N stands for net. So when we are considering the NPP, it means monetary value of all final goods and services produced within an accounting year excluding depreciation. It means we are excluding here the depreciation amount. Whereas on the other hand, when we are talking about the GDP, as this G stands for gross, it means we are going to include depreciation. That is, GDP is the monetary value of all final goods and services produced during an accounting year, including the depreciation. Now coming to the GDP at market price. Since it is talking about the concept related to market price, we will add or we will calculate the monetary value of all final goods and services at market price, at given market price. That's why we are adding the net indirect taxes. And when we are talking about the GDP at factor cost, then we are excluding this net indirect taxes. So this was the concept of GDP, GNP, NDP, GDP and GDP at MP and GDP at FC. So after this we will discuss how these aggregates or how we can use these aggregates to conclude or to find out the another aggregate from the given one. Suppose if you are given the GDP at market price, then how you are going to calculate it from gross national product. Suppose you are given the gross national product and you are said to calculate GDP at market price. Then how we will reach from GNP to GDP? Let us understand how we will convert So this was